Picture this. A young investor in 1958 puts money into a small company called Motorola. 40 years later, that investment has grown by over 20,000%. This isn't fantasy or luck, it's the result of following principles outlined in one of the most influential investment books ever written. Today, we're diving deep into Philip Fisher's masterpiece, Common Stocks and Uncommon Profits, a book that revolutionized how investors think about growth stocks and changed the investing world forever. Most people think investing is about numbers, charts, and complex financial formulas. But what if I told you that the secret to extraordinary investment returns lies not in spreadsheets, but in understanding businesses like a detective? Fisher discovered something that Wall Street professionals had been missing for decades, and today you'll learn exactly what that was. From a Stanford University professor who became one of history's most successful growth investors, this book contains strategies that Warren Buffett himself credits as fundamental to his approach. We're talking about principles so powerful that they've created more millionaires than almost any other investment philosophy. But here's the kicker. Most investors completely ignore these strategies because they seem too simple. Common stocks and uncommon profits emerged from Philip Fisher's decades of experience as a growth stock specialist, who consistently outperformed the market from the 1930s through the 1990s. Published in 1958, this groundbreaking work challenged the prevailing investment wisdom of its era, which focused heavily on value metrics and dividend yields rather than growth potential. Fisher wrote this book during a transformative period in American business history. The post-World War II economy was experiencing unprecedented technological advancement and corporate expansion. Traditional investment approaches, rooted in Depression-era caution, were proving inadequate for identifying the next generation of industry leaders. Fisher recognized that investors needed a completely different framework to capitalize on this new economic landscape. The book represents Fisher's attempt to systematize his investment methodology, which he had developed through years of hands-on experience managing client portfolios. Unlike many investment texts that rely heavily on quantitative analysis, Fisher's approach emphasized qualitative research and deep business understanding. He believed that truly exceptional investments required investors to think like business owners rather than stock traders. What makes this book particularly significant is its practical applicability. Fisher didn't write from an ivory tower. He was actively managing real money for real clients while developing these concepts. Every principle he discusses emerged from actual investment decisions, both successful and unsuccessful. This real-world foundation gives the book a credibility and relevance that purely theoretical works often lack. The timing of the book's publication proved prescient. The following decades would witness the rise of technology companies, pharmaceutical innovations, and service industries that perfectly match Fisher's investment criteria. Many investors who applied his principles during this period achieved extraordinary returns, validating his approach across multiple market cycles and economic environments. Fisher's central thesis revolves around the concept that superior investment returns come from identifying companies with exceptional growth characteristics and holding them for extended periods. He argues that investors should focus on finding businesses with sustainable competitive advantages, outstanding management teams, and significant expansion opportunities, rather than seeking undervalued securities based solely on current financial metrics. The book introduces Fisher's famous 15 points, a comprehensive framework for evaluating potential investments. These criteria encompass everything from a company's research and development capabilities to the integrity of its management team. Fisher believed that companies meeting most of these criteria possess the fundamental qualities necessary for long-term success and stock price appreciation. A crucial element of Fisher's methodology involves what he calls scuttlebutt research, gathering information about companies through conversations with customers, suppliers, competitors, and former employees. This qualitative research approach allows investors to understand business dynamics that financial statements alone cannot reveal. Fisher considered this investigative work essential for making informed investment decisions. The book also addresses the psychological aspects of investing, particularly the importance of patience and discipline. Fisher advocates for a buy and hold philosophy, arguing that frequent trading undermines long-term wealth creation. He emphasizes that truly great investments often require years, or even decades, to reach their full potential, and investors must resist the temptation to sell during temporary market downturns. Fisher challenges conventional wisdom about diversification, suggesting that investors achieve better results by concentrating their holdings in a smaller number of carefully selected companies rather than spreading investments across numerous mediocre opportunities. This concentrated approach requires thorough research and strong conviction, but Fisher argues it leads to superior long-term performance for knowledgeable investors. The foundation of Fisher's investment philosophy rests on his revolutionary 15 points evaluation system. Rather than relying solely on financial ratios and balance sheet metrics, Fisher developed comprehensive criteria for assessing a company's long-term growth potential. These points examine factors like management quality, market positioning, research and development effectiveness, and corporate culture. Fisher believed that companies excelling in most of these areas possessed the fundamental characteristics necessary for sustained success. His approach required investors to think beyond traditional valuation methods and consider qualitative factors that couldn't be easily quantified but ultimately determined business outcomes. Fisher pioneered the concept of scuttlebutt research, which involves gathering intelligence about companies through extensive conversations with industry participants. This investigative approach includes interviewing customers to understand product satisfaction, speaking with suppliers about payment practices and business relationships, talking to competitors about market dynamics, and consulting with former employees about internal company culture. Fisher argued that this grassroots research provided insights unavailable through conventional financial analysis. He spent considerable time developing networks of industry contacts who could provide honest assessments of companies he was considering for investment. The book strongly advocates for concentrated investing rather than broad diversification. Fisher believed that investors achieve superior results by focusing their holdings on a small number of exceptional companies rather than spreading investments across numerous mediocre opportunities. He argued that thorough research and deep understanding of selected companies provided better risk management than statistical diversification. This approach required investors to develop strong convictions about their holdings and resist the temptation to chase every attractive opportunity. Fisher practiced this philosophy throughout his career, often holding significant positions in just 10 to 15 companies. Fisher emphasized the critical importance of outstanding management teams in creating shareholder value. He developed specific criteria for evaluating management quality, including their ability to allocate capital effectively, maintain honest communication with shareholders, and adapt to changing market conditions. Fisher looked for leaders who demonstrated both operational competence and strategic vision. He believed that mediocre management would eventually undermine even businesses with strong competitive positions, while exceptional leaders could transform ordinary companies into market leaders. This focus on management quality became a cornerstone of his investment methodology. The book introduces Fisher's concept of the growth stock as distinct from traditional value investments. He defined growth stocks as companies with above-average potential for increasing sales and profits over extended periods. Fisher argued that these companies deserved premium valuations because their earnings growth would eventually justify higher stock prices. He distinguished between companies with short-term growth spurts and those with sustainable competitive advantages enabling long-term expansion. This framework helped investors identify businesses capable of delivering exceptional returns over multiple years or decades. Fisher advocated for extremely long holding periods, often measuring investment success across decades rather than quarters or years. He believed that truly exceptional companies could compound shareholder wealth over extended timeframes, but only if investors maintained their positions through various market cycles. Fisher argued that frequent trading destroyed wealth through transaction costs and poor timing decisions. His philosophy emphasized patience and conviction, encouraging investors to think like business owners rather than stock speculators. This long-term approach, the book addresses the relationship between stock prices and business fundamentals, arguing that market prices eventually reflect underlying company performance despite short-term volatility. Fisher believed that investors who focused on business quality and growth prospects would be rewarded as markets recognize these attributes over time. He encouraged investors to view temporary price declines as opportunities to increase positions in high-quality companies rather than reasons to sell. This perspective helped investors maintain perspective during market downturns and avoid emotional decision-making that often destroys long-term returns. Fisher developed specific criteria for determining when to sell investments, which he considered equally important as knowing when to buy. He identified 3 primary selling situations: when the original investment thesis proved incorrect, when a company's growth prospects fundamentally deteriorated, or when significantly better opportunities became available. Fisher discouraged selling based solely on price appreciation or market conditions, arguing that these factors were irrelevant if the underlying business remains strong. His selling discipline helped investors avoid premature exits from successful investments while protecting capital when business fundamentals deteriorated. Understanding that exceptional investment returns require a fundamentally different approach than conventional wisdom suggests represents Fisher's most important insight. Most investors focus on statistical measures like price to earnings ratios or dividend yields, but Fisher demonstrated that sustainable wealth creation comes from identifying companies with superior growth characteristics and competitive advantages. This approach requires investors to think beyond current financial metrics and consider factors like management quality, market positioning, and long-term growth potential. The key is recognizing that truly exceptional investments often appear expensive using traditional valuation measures, but prove to be bargains when measured against their ultimate performance over extended periods. Developing comprehensive research capabilities beyond financial statement analysis becomes essential for implementing Fisher's methodology successfully. The scuttlebutt approach requires building networks of industry contacts, developing interviewing skills, and learning to synthesize qualitative information into investment insights. This research process takes time and effort, but provides competitive advantages unavailable to investors relying solely on publicly available information. Successful implementation requires treating investment research like investigative journalism, seeking multiple perspectives, and corroborating information from various sources to build accurate pictures of business prospects. Recognizing that concentration rather than diversification often produces superior investment results. Challenges conventional portfolio management wisdom. Fisher's approach requires developing strong convictions about selected companies and maintaining significant position sizes despite short-term volatility. This strategy demands thorough research, emotional discipline, and confidence in one's analytical abilities. While concentration increases portfolio volatility, it also maximizes the impact of successful investment decisions. The key is ensuring that concentrated positions represent thoroughly researched companies with exceptional growth prospects rather than speculative bets. Learning to evaluate management quality becomes crucial for long-term investment success, since leadership capabilities often determine business outcomes more than industry dynamics or market conditions. Fisher's criteria for assessing management include examining their track record of capital allocation decisions, communication style with shareholders, and ability to adapt to changing circumstances. Outstanding managers create shareholder value through strategic vision, operational excellence, and ethical behavior. Investors must develop skills for evaluating these qualitative factors, since management quality rarely appears in financial statements but profoundly impacts long-term business performance. Understanding the true nature of growth stocks requires distinguishing between companies with temporary earnings increases and those with sustainable competitive advantages enabling long-term expansion. Fisher's framework helps investors identify businesses with pricing power, market-leading positions, strong research and development capabilities, and expansion opportunities. These companies often command premium valuations but justify higher prices through consistent earnings growth over extended periods. The challenge lies in differentiating between genuine growth companies and businesses experiencing cyclical upticks or one-time benefits that won't sustain long-term performance. Creating systematic selling criteria helps investors avoid emotional decision-making while protecting capital when business fundamentals deteriorate or better opportunities emerge. Fisher's three-part selling framework provides objective standards for evaluating whether continued ownership makes sense. This discipline prevents investors from holding position too long when circumstances change while avoiding premature exits from successful investments. The challenge lies in distinguishing between temporary setbacks and fundamental deterioration in business prospects. Successful implementation requires regular monitoring of company developments and honest assessment of changing circumstances. Learning to think like a business owner rather than a stock trader fundamentally changes how investors approach market opportunities and evaluate potential investments. This mindset shift emphasizes understanding business economics, competitive dynamics, and long-term prospects rather than focusing on short-term price movements or technical indicators. Business ownership thinking encourages investors to welcome market volatility as opportunity rather than threat. The key is developing deep understanding of how businesses create value and generate returns for shareholders over extended periods. Recognizing that superior investment results require accepting higher short-term volatility in exchange for better long-term performance helps investors maintain appropriate expectations and emotional discipline. Fisher's concentrated, growth-oriented approach produces more volatile returns than diversified portfolios, but generates superior wealth creation over extended periods. This trade-off requires investors to focus on long-term wealth building rather than minimizing short-term fluctuations. Success demands maintaining perspective during difficult periods and remembering that volatility represents the cost of achieving exceptional returns. Building conviction through thorough research enables investors to maintain positions during challenging periods and maximize the potential of successful investments. Fisher's methodology requires developing strong analytical capabilities and confidence in one's research conclusions. This conviction allows investors to increase positions when markets provide attractive opportunities rather than selling during periods of uncertainty. The key is ensuring that conviction derives from solid research and analysis rather than wishful thinking or emotional attachment to particular investments. Philip Fisher's Common Stocks and Uncommon Profits remains one of the most influential investment books ever written because it fundamentally changed how investors think about creating wealth in the stock market. Rather than focusing on traditional value metrics or short-term market movements, Fisher demonstrated that exceptional returns come from identifying exceptional companies and holding them through multiple market cycles. His emphasis on qualitative research, management quality, and long-term thinking created a framework that has proven successful across different economic environments and market conditions. The book's enduring relevance stems from its focus on timeless business principles rather than temporary market conditions or specific investment techniques. Fisher's 15-point evaluation system and scuttlebutt research methodology remain as applicable today as they were when first published. Modern investors can still use these tools to identify companies with sustainable competitive advantages and outstanding growth prospects. The key insights about management quality, business economics, and long-term thinking transcend specific time periods or market environments. Perhaps most importantly, Fisher's work demonstrates that successful investing requires a fundamentally different mindset than most people adopt. Instead of seeking quick profits or following market trends, exceptional investors focus on understanding businesses and identifying companies with the potential to create enormous shareholder value over extended periods. This approach demands patience, discipline, and confidence in one's research abilities, but provides the foundation for building substantial wealth over time. Fisher's legacy continues through the countless investors who have applied his principles to achieve financial success while staying true to his philosophy of finding common stocks with uncommon profit potential.